Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone.
Good morning.
Today, we're going to take a deep dive into some of the really significant financial stories making the rounds. We're pulling insights from reports in CNN Business, CNBC, Yahoo Finance, Bloomberg, and MarketWatch.
Quite a range of sources there.
Exactly. And our goal is really to cut through the noise, understand the potential impact of these developments. We'll be focusing on U.S.-China trade relations,
Always a big one.
President Trump's recent Middle East trip and its tech implications, the latest inflation data, key company earnings, and of course how the markets are reacting.
Okay, lots to cover. It's fascinating, isn't it? How all these pieces are interconnected.
It really is.
You see global trade policies and how they can ripple right through, say, the tech sector, and then ultimately influence the bigger picture, like inflation.
Like watching complex gears turning.
Exactly. One change affects the whole system. So where should we start? U.S.-China.
Yeah, let's start there. CNBC's Asia-Pacific Markets Live report mentioned Asian markets were mostly higher. That followed the apparent easing of U.S.-China trade tensions.
Right, a bit of relief rally there.
But interestingly, they also noted strategists at Julius Baer are still, well, cautious. They don't see a quick resolution.
That sounds about right. I mean, the market reacts to the immediate news, the de-escalation, right? But the underlying problems,
Still there.
they haven't necessarily gone away. Look at the CNBC China Connection report. It highlighted this 90-day tariff truce. It's just temporary, a pause.
So businesses are still kind of scrambling.
Well, they're definitely grappling with the uncertainty, thinking about future tariffs, reevaluating supply chains. What really stood out in that report, though, was China's increasing focus on self-sufficiency.
Ah, right, in critical tech and resources.
Exactly. This isn't just about tariffs anymore. It feels like a bigger strategic shift with potentially huge long-term implications for global supply chains, for competition.
That self-sufficiency angle is crucial. And MarketWatch had that piece on Goldman Sachs' analysis. They basically said the recent market dip was event-driven, specifically Trump's tariffs.
Makes sense. The cause and effect seemed pretty direct.
And then the pause led to this relief rally. Bloomberg and Yahoo Finance also reported on that, how it erased the S&P 500's losses for the year.
Quite the turnaround.
Yeah, and Goldman Sachs actually adjusted their outlook because of it. Reduced the probability of a recession, raised their S&P 500 target.
It shows how much the market had priced in, the risk of escalating trade tensions. The pause unwound some of that pessimism.
But they're not saying it's all clear skies ahead.
No, not at all. Their advice, according to MarketWatch, was actually to diversify away from the U.S. market, focus on quality growth, value companies elsewhere.
Interesting. So caution remains.
It suggests they see the global landscape as still complex, potentially volatile. It's like adjusting your sails slightly because the wind changed, but you're still navigating carefully. You're prepared for more shifts.
Okay. And tying this together is that CNBC report on U.S. Treasury yields. It mentioned calmer investor worries about tariffs coincided with that lighter-than-expected inflation data.
And the U.S.-China truce news. Yes.
It really feels like all these factors are feeding into each other, shaping market expectations.
Precisely. Lower inflation, and we can talk more about that in a moment, combined with fewer trade worries, it just paints a less threatening picture in the short term.
And that shows up in the bond market.
Right. Treasury yields moved lower, reflecting less anxiety. It highlights how something like trade talks, a geopolitical event, directly impacts macroeconomic indicators and how investors behave across different assets.
Okay, let's shift gears. President Trump's recent trip to the Middle East, that CNN Politics article, A Home Away from Home, it was a fascinating angle.
It really was.
It highlighted his, apparent admiration for how fast things get done in the Gulf states, development-wise, and his pursuit of investment, reportedly around $600 billion in new commitments.
That piece definitely points to a unique aspect of his approach to foreign relations. Deals, investment, seem to be front and center.
Almost like he prefers that model.
Well, the article suggests his admiration for the speed and scale there might stem from wanting similar large projects in the U.S., maybe without, the usual hurdles.
Regulatory, political hurdles.
Exactly. And chasing that Gulf investment, it has potentially big geopolitical consequences. Could reshape alliances, economic dependencies.
And a lot of that investment seems aimed at tech, right? CNN Business reported on that Trump touts U.S. tech to power post-oil future.
Yes, big deals with Saudi Arabia involving AI chips, NVIDIA, AMD, Qualcomm.
And this was helped by a shift in administration policy on exporting those chips.
Apparently so. A policy shift regarding AI chip exports, plus they announced a new Saudi AI startup, Humane.
So what's the bigger picture there? Is it just about selling chips?
I think it underscores a strategic alignment between the U.S. and certain Gulf nations, especially Saudi Arabia, in advanced tech. They need to diversify away from oil, right?
And AI is key to that future growth.
Exactly. And the U.S., being a leader in AI chips, becomes a crucial partner. The policy shift seems like a calculated move to leverage that, strengthen economic ties, and maybe even influence tech development in the region.
Then you had the Yahoo Finance article, Why NVIDIA is the Tech Winner of the U.S.-China Tariff Truce. It specifically mentioned NVIDIA's CEO being in Saudi Arabia.
And that huge deal, 18,000 AI chips to Humane.
NVIDIA seems to be winning on multiple fronts, easing trade tensions, booming AI demand.
Absolutely. Yahoo Finance really nailed it. NVIDIA's perfectly positioned. The Saudi deal shows they can land massive contracts in these new expanding markets.
But the article raised a concern too, didn't it?
It did. The potential for those advanced chips to somehow get diverted to China. It highlights that ongoing tension, balancing economic opportunity with national security, especially around technology transfer.
And it wasn't just Saudi Arabia. Bloomberg reported a potential deal for the UAE to buy a large number of NVIDIA chips too.
That's right. Interest from both Saudi Arabia and the UAE. It really cements the Middle East as a major emerging market for AI.
Seems like a long-term commitment across the region.
It does. Integrating AI into everything from smart cities and energy to finance and healthcare. Huge opportunities for tech providers.
Okay, let's talk inflation. Good news there, apparently.
Yeah.
CNBC's Daily Open report said U.S. inflation in April was lower than expected.
Yes, that was significant. It eased some of those fears about tariffs, immediately pushing up prices across the board.
And less worry about stagflation. That slow growth, high inflation combo.
Exactly. The immediate threat seems diminished. They even noted it was the lowest annual inflation rate since 2021.
Wow, that's definitely welcome news.
It is. It offers some reassurance. Maybe businesses absorb some costs. Maybe other inflationary pressures cooled off. Whatever the reason, it suggests a potential shift.
And Bloomberg's report on gold. Gold edges lower.
Yeah.
Tied this to the Fed outlook, Ryan.
It did. The thinking is softer inflation gives the Fed more room to maybe consider rate cuts down the line.
Which makes gold less attractive.
Less attractive compared to assets that might offer a yield, yes. Especially when trade optimism is also rising. So the opportunity cost of holding gold, which doesn't pay interest, goes up. Investors might shift towards riskier assets.
Classic interplay, as you said.
It is. And that combination, better trade mood, tame inflation, puts downward pressure on gold.
And circling back to bonds, that CNBC report on Treasury yields. Yields moved lower as investors digested both the inflation news and the trade progress.
Exactly. The bond market reaction, lower yields, reflects a feeling of slightly less immediate economic risk. Things feel a bit more stable, at least for now. It influences expectations about growth, about monetary policy.
Right. Let's move on to some company specifics. Burberry earnings, CNBC reported their stock jumped,
It did. They announced new cost-saving steps, a turnaround plan.
even though sales in the Americas were down.
Yes, despite that. And analysts are still cautious about the timeline, which CNBC also noted in their European market updates. Revitalizing a luxury brand takes time.
So the market liked the plan, even if results aren't there yet.
It seems investors were encouraged by the proactive steps. The plan itself signaled commitment. But yeah, the caution from analysts is important context. It's a tough market.
We also saw Sony shares rise, according to another CNBC report. Stock buyback? Better than expected operating income.
Positive signals there.
But their forecast was a bit muted, partly because they'd factored in negative impacts from the trade war.
Yes, and the report suggested that forecasts might now be revised given the truce. It's a perfect example of how these big trade policies directly hit multinational companies' projections.
And the buyback probably helped the stock too.
Oh, almost certainly. It often signals management confidence, boosts shareholder value.
Okay, and on the IPO front, eToro, the trading platform. CNBC said they priced their IPO at $52 a share, higher than expected.
That's right, and apparently they'd held off earlier because of trade uncertainty.
So this suggests the IPO market might be opening up again. More appetite for new offerings.
It could be a sign, yeah, a thawing, perhaps. If they felt confident enough to proceed and upsize the offering, it suggests more stability, better growth prospects perceived in the market. Might encourage others waiting on the sidelines.
And finally, NVIDIA again. Yahoo Finance highlighted that huge stock surge, pushing their market cap over $3 trillion,
Incredible milestone.
attributed to both trade optimism and just explosive AI demand.
They really are in a sweet spot, aren't they? As Yahoo Finance pointed out, they benefit from easing trade tensions and that insatiable demand for their AI chips. Their dominance is clear.
Just a couple of other quick market movers. Bloomberg mentioned President Trump's inferred preference for $40, $50 oil based on his social media.
Yeah, and they noted a correlation between his posts and price swings. It's a reminder, isn't it, how political talk can sometimes move markets?
Definitely. And Bloomberg also noted oil prices holding gains, driven by trade optimism, but also Iran friction, competing forces there.
Right. Trade optimism boosts demand hopes, while Iran tensions raise supply concerns, often keeps prices in a bit of a balance.
MarketWatch also flagged strong performance in German, Italian, and Hong Kong stocks, potential diversification plays. Echoes that Goldman advice.
It does. Reinforces that idea of looking beyond the U.S. for opportunities, managing risk through diversification. Investors seem to be taking that on board.
And lastly, CNBC mentioned Samsung launching that ultra-thin Galaxy S25 Edge, getting ahead of Apple's expected similar phone.
Ah, the smartphone wars continue. Constant innovation, intense competition. Samsung trying to get that edge, literally.
So, wrapping this all up, it seems clear that U.S.-China trade truce was a major catalyst recently. It shifted market sentiment, especially in tech, eased recession fears a bit.
Definitely a key driver.
Then you have President Trump's Middle East efforts forging these new tech partnerships.
Reshaping economic ties there.
While the latest inflation data gives the economy some breathing room, it's a really complex picture, isn't it? So many interconnected parts.
It really is. I think the main takeaway is just how interconnected everything is. A temporary trade truce ripples everywhere. Actions in the Middle East aren't just about oil anymore. They're shaping the future of tech. And inflation data provides that crucial check on the economy's health, influencing Fed thinking. It's all incredibly dynamic.
A lot for investors and everyone watching the markets to keep track of.
No kidding. Constant vigilance required.
We'll see you all tomorrow morning with new headlines from major financial magazines.